Okay, testing. Can I make sure you can all hear me, please? This is going to be quite an important review of non-farm payrolls and how different people have traded non-farm payrolls, some successfully, some unsuccessfully. And I would like to review this from a behavioral perspective. Can I just check you can all hear me? Testing. Okay, great. So before the objective of this short video, guys, is to talk about a couple of our traders that managed to take something out of non-farm payrolls, and an example as well of perhaps someone trading non-farm payrolls poorly. The purpose of this quick session is so you guys can see, when people are on the live, when they're making decisions with real money, how their timing can impact the final result of the trade, even though everybody is getting exactly the same data at exactly the same time. How do we as individual traders compute that data and act on that data in different ways? So first of all, let me just have a quick review of the data itself. This is on the Trading Live page then. One of the key elements to this is the average hourly earnings coming out at 0.4% versus 0.2%. So this was a firm market mover in terms of some inflation being able to come through in the US earnings system. Coupled with that, we've got the strong data itself from NFP. So these two heavyweight beats really giving us a firm move in asset prices, which I covered in the morning briefing. So let's have a look at the euro dollar. Obviously that data with this red candle being shown on the far right hand side, that data being enough to push us below the May low, July low, August low that we saw earlier on in this year. So obviously dollar strength on the back of that data. So first of all, let's have a look at how one of our traders executed on the euro US dollar. So this is a 5-minute chart here. And you can see that the data, if I just pull up this, just slide it to 130 exactly. So that's the first move, 130. So here we are coming up to that data. Actually, we do have a move just as we're getting into that data. The data comes out stronger than expected. We break below S1, below S2. Just selling one contract. It's a new trader just going short one contract. Hold on, let me repost the chart. Do let me know if there's any issues, of course. So just going short one contract, but what I really like about this execution is not holding on to this trade, using this momentum. So getting out whilst this momentum's in his favor. We do then bounce back and we go back to that level that this trader got out, but really you can see he's in this position for 5 minutes. When you're trading moves and data like this, it's much easier when you've got multiple contracts. If you had multiple contracts, perhaps you can take one off here and leave the other one on. But very often I'm more impressed by our guys when I see proactive exits. There's a proactive exit. So this trader getting short at 1.0780. Now if you look at how he executed that, if I just go to his account here. So this is there's two things I like about this. Let me just slide this over. So there's two things I like about this. You can see he's going short. What do you think that M stands for how he got into that trade? What does that M stand for? Well, that's a market order. This is a trade with confidence, a market order, and also a market order on the way out. Recognizing that momentum stop, we've had that big push, a market order on the way out, and that was a really nice trade with just one contract. That's $600 or $700 with just one contract, which is phenomenal. So with just one contract, the smallest size you can trade, that was a $700 trade. Now, you see, when you look at this chart in hindsight, you think, oh, well, people might think, well, I've missed the move, I've missed the break lower there, and I wanted to get in at S1. But the two key things here is having the confidence to hit it at market, understanding the fundamental strength of this data. Secondly, being proactive on the exit. And the third, and perhaps most important point, what else do you notice about this trader's filled orders for the day? What else is evident looking at his filled order history there? Okay, yeah, 40 seconds in the trade for 40 seconds, which for non-farms is actually not too short a time. What else strikes you as interesting? Well, as a mentor, what strikes me as interesting is the fact that there were no additional trades. How often have you been in this situation and you absolutely nail one trade and then you allow yourself to just give some of that profit earned away? You know, so good risk management there, good mentoring. There's no point in, you know, if $700 of one contract is a phenomenal result. Imagine if you're trading 5 or 10 contracts. You know what kind of day you're looking at there. But yeah, really good discipline. No other trades. So well done. So that was getting short on the EURUSD at 1.0780. Now I'm looking at another trader here, very similar. They where did they get short here? So you know they missed even more of the move, so they're going short at 67. So this is 13 ticks. 13 ticks after that first trader that I showed you entered the market. So 13 ticks afterwards. So do you think he felt like he missed the boat? You know, no, on just one trade there with one contract. Again, this is a new trader, just one trade and one contract, $537.50. So again, excellent discipline, one trade, both of them proactive on the exit. There's, you know, no one, you can't complain too much when you make money, especially in something where non-farm payrolls, where you do get a lot of whippiness. And with the euro dollar, they're good to go for a quick exit, given how much pressure the euro dollar has been under, you know, leading into this figure. So two excellent euro dollar trades, both of them, nothing before the data, nothing after the data, assassin-like execution, very disciplined. Can't see the second. Let me just share the chart again. One moment, please. So here you've got the second. Assassin-like execution on that non-farm. That's when non-farm payrolls goes well. You know, you've got a big fundamental move. You've got everything in terms of our trading setup ticks. Is this the major data release? Yes. Is the actual result much larger, much higher, much lower than expected? Yes. And indeed, you know, when all of these boxes are ticked, then you've got a market order type of trade. And again, this second trader, both of his executions at market. So then we're going to look at a trader now that traded the S&P. So we've had a look at two guys that took some money out of this question. Victor, I'll answer your question after this this moment. So we've had a look at two guys that traded that well. This is the S&P now. And with this trader, if you give me one moment here, so you can see he executed twice. Now, one thing that Piers says time and time again, no Bill says it, is trading equities of US data is complicated, and it always has been complicated. Is this data a buy or a sell? For equities, you see, I don't really know, because it's excellent data for the US, so it's a buy. It shows sign of strength in the economy, strength in the job market, but it might also mean that the Fed can move rates sooner than expected, so then it's a sell. And I think how the S&P moved showed exactly that, showed exactly this conundrum. And it wasn't necessarily that this trader acted too badly on the first trade, so not too dissimilar to what was happening in the euro dollar. Let's really wind it back here. So this is what this trader saw. I'm on a 2-minute chart now. Non-farm payrolls data comes out. The S&P was trading at 2095. We move all the way down to 2082, and this is where he gets short, 2082. Perhaps believing, well, let's have a look. You know, what technicals would this guy have been looking at? Perhaps believing that, right, we've broken below S1. So, you know, I want to see whether the equity market takes this as a bearish or a bullish move, and we broke through S1, perhaps confirming why the S&P or why this trader did execute shorter here. It's hard to criticize this trade too much, other than the fact equities is not the product to trade on US data. If you are going to trade equities though, definitely wait until the market has shown you whether it sees this, if it does see this data as bullish or bearish. And this trader did wait until S1 got broken, and he did manage his stop incredibly well, placing it just above S1. So this was a bad trade, well managed. Does that make sense? This was a well managed bad trade. So this trader should still take something from that. That's discipline there. This I don't have too much of a problem with. Equities, okay, ideally he should have traded another product, but having traded equities, he waited for a break of S1, a technical break, before going short. He placed his stop just above S1. So that was a bad trade, well managed. The problem, as Dara is quite rightly predicting here, so you can see Dara saying in the trading live room here, the fault is probably that he jumped in again. Looking at this trader, the fault might be that he jumped in again. I did the same thing myself on Friday and regretted. Well, I haven't even shown you what happened, Dara, but you've hit the nail on the head. That in itself wasn't a bad trade, but the next execution just really cemented that loss. So went short, stopped out. The next candle, by the way, we then saw us go to nearly 2100 in the S&P, so a full reversal of that move lower. We then come tearing down towards, now this second trade, what are the technical rationale on this second trade? Who can see the technical rationale? On the first trade, break of S1, stop above S1, that's a nice setup technically, given the fundamental move. What do you notice about the technical points on the second trade? I can't see any. I can't really see as much technical justification here for that second entry, other than he went short, stopped out, the market then tore higher, it then tore lower. He wanted to see the S1 get taken out again. And very often you trade what you want to see. He wanted to see that S1 get broken again. He wanted to see, it's like, right, here we go. Now that everyone's been wiped out, let's get on this. And unfortunately, that second trade, in terms of loss, eclipsed his first trade. So he more than doubled his loss by this second trade. And that's the killer with non-farm payrolls. By all means, trade it, and trade it aggressively. But if you do, this first trade was incredibly well managed. This really shows a lot of good training and a good discipline, a good approach if you are going to trade equities. It's that second one that often we can only blame ourselves for and regret. So I hope you found that useful, guys. A couple of examples, two traders who looked at the euro dollar, clean execution, went with momentum, and that trade obviously worked out. Both of them proactive with the exit. The third trader that we looked at, okay, it was the wrong asset to trade, but he managed it very well. I don't have a problem with that first trade. The second trade is the one that then does the damage to the P&L, and they're the ones that we can control, and they're the ones that we can mitigate for the benefit of our longer term trading P&L. I hope you guys found that useful.